What does it mean when investor returns don't equal investment returns? The famous Magellan Fund has long been held as an example. Here's how the story goes. Peter Lynch was the portfolio manager of Fidelity's Magellan Fund. Between 1977 and 1990, his period of tenure, the fund returned a remarkable average of 29% per annum. The Magellan Fund became the gold standard for quality stock portfolios. According to urban legend, investors in the fund actually lost money over this time period. The theory goes, investors would buy the fund at its peak before selling at the first sign of trouble or uncertainty. The lesson is that poor investor timing can lead to poor results when compared to simply buying and holding an investment. No one knows exactly how this myth was born, but the lesson of the story holds true for many investors. Take, for example, the Dalbar study in 2022. The study looked at the effect investor behaviour has had on returns. They looked at buys and sells investors made in the mutual funds to determine how the average investor has performed. When comparing this to a benchmark like the S&P 500, we can see how much the average investor's behaviour has cost them. Dalbar found that between 1993 and 2022, investors on average returned 6.8% per annum in mutual funds, whereas the S&P 500 returned 9.6% per annum. On average, it has cost investors around 2.8% every year, simply because they sought to time the market rather than buying and holding their investments. We've done some similar research on one of our most popular ETFs. Here is our Nasdaq 100 ETF, which returned 14.1% per annum in the last 3 years to 31 December 2023. But investors in the fund returned on average just over 13.5% per annum. That's a 0.6% difference every year that investors miss out on because of their behaviour. This difference is what is commonly referred to as the behaviour gap. The behaviour gap occurs because investors' market timing can negatively impact their returns. Investors might be tempted to buy and sell based on short-term market movements or the latest news, rather than sticking to their long-term investment plans. Generally speaking, our research shows that investors have not been good at timing the market. On average, an attempt to time the market and pick the best performing days while avoiding the worst performing days ends up giving worse performance than just holding an investment for the relevant period. So, as an investor, how can you seek to minimize this behavior gap? Here are a few ways. Firstly, avoid funds that charge high fees. Management and performance fees charged by active managers can be costly. These fees eat away at fund returns. In order to prevent the associated costs and widening the behavior gap, consider choosing active managers with low performance fees or even replacing them with passive investment alternatives. Managers will disclose their management and performance fees, as well as more complex intricacies like high watermarks on the fund webpage or in the fund PDS. Second, avoid trying to time the market. We've covered market timing in the past, and it's been the case that investors are consistently poor at choosing when to buy and sell. Usually, a better approach is to buy and hold based on your long-term investment strategy or to invest on a regular schedule. This should not only help to improve your investment returns, it's also probably going to help you sleep sounder at night, knowing that you don't have to concern yourself with daily up and down movements. And finally, have a solid financial plan in place. This will help you better control emotions in times of market turmoil and volatility. The better you can stick to your plan, the less likely there'll be a behavior gap. Take those 3 tips on board to help minimize the behavior gap and give yourself a better chance of building your wealth.